All right, it's recording. So I'll just give a few seconds of silence, give my intro, and then we'll just start and be like super casual, whatever.
Sounds good.
Cool.
Yeah, it's like super casual. You guys aren't into like anything crazy, right? Like
No.
it's basically a casual conversation.
Have you listened to any other episodes before?
No, I haven't, but like I can use bad words and it's not a problem.
Yeah, I swear all the time on my show.
Good.
Yeah.
All right, this will be fun.
All right, perfect. Hi, this is Eric Schleien. You're listening to the Intelligent Investing Podcast, and today we have on Harris Kupperman, also by the name of Kuppy, as you may know him through his blog. He is the CIO of Praetorian Capital. Kuppy, welcome to the show.
Hey, thanks for having me on.
No, dude, I'm happy to have you on. You're one of my favorite blogs to read online, so it's
appreciate that. Honored, actually.
Yeah, I feel like we've talked before in Omaha, Nebraska, the Berkshire meeting. I'm sure at some point, but it's nice to like have you on my show and just be able to like sit down, kick back, and have like a good conversation. So
yeah, absolutely. And if we met at Berkshire, honestly, I don't remember it. I meet 200 people each Berkshire, and I don't think I'm sober at all.
Yeah, with the amount of alcohol and the 40,000 people that come every year. And how many meetings have you been to?
Probably about 15 of them.
Yeah, okay.
But the best part of Berkshire isn't the meeting. I mean, the meeting is whatever.
No.
It's going out like after the meeting's done at about 4 and staying out to about 4 in the morning with all your friends and going to all the private parties. And
yeah,
it's one of these things where like everyone hosts a little get together for like 2 hours, and you just go basically party to party to party and sing all your friends. And some of them come from so many different countries. It's just so great because you don't see them in one place any other time of each year.
Do you actually attend the actual Q&A at this point?
Yeah, I sit down, but I could give I can answer the questions more or less. Like, you know what they're going to say.
You already know. Yeah, it's funny. You almost can tell what they're going to say before they say it.
Yeah, pretty much.
Yeah.
This is not very many surprises.
No. Now, listening to Charlie, I know you said when we talked a little bit before the show, you were at the last Wesco meeting with Charlie. I've been to a Daily Journal meeting. That to me is a little bit more interesting, listening to Charlie Munger speak for hours and hours.
I bet. I mean, Charlie is he's interesting. He really is. And you can ask him anything. How many people go to the Daily Journal meetings now?
Maybe 1,000.
Wow. When we did the Wesco, it was maybe 200-300. And like he stayed there until they ran out of questions. And, it's not like the Berkshire where you have to, bum rush the mic to get a spot. Literally, the mic was there, and there's about a 3-person wait, and you could ask him anything you wanted.
Yeah. It's still like that at Daily Journal. So
that's great.
Yeah. So what have you been up to these days? You're running Praetorian Capital. You do a bunch of stuff. So what are you up to these days?
Well, I'm running my hedge fund. It's been a pretty good year, actually, which is, it's been a volatile year, but it's been a very good year. And I feel like Q4 is going to be pretty good once we get through the election. I've been doing a decent amount of traveling. The borders are closed, so I'm traveling the United States. And, it's kind of funny. I live in South Beach. I've been here 16 years, and I've really never gone north of Boca, effectively.
Really?
I knew nothing about my own state. I knew, places in Central Asia better than 100 miles north of me. And so my wife and I, we just, for the last, year maybe, we've been driving around Florida, but with COVID, we just said, let's just go all the way as far north as we can get. And we made it all the way to Virginia, basically, just going up the seaboard and then kind of cut over into the Blue Ridge and came back through Tennessee. And it's a beautiful country. I'm kind of surprised that I've never taken the time to see more of America. I've kind of always been one of those snobs that, you go to Europe for your vacation, or, you go to some screwed up country because none of your friends have ever been. But
right.
I don't know. There's some pretty cool places in America too, and I don't think they get the credit that they deserve. So
the Blue Ridge area is amazing too.
Oh, it's so beautiful.
Driving out there, yeah.
Yeah, it's great. I'm really happy I did that.
Did you make it into West Virginia at all?
No, we didn't make it to West Virginia.
I will tell you.
Yeah,
driving through West Virginia and stopping in some of these rural towns and listening to the old school Appalachian accent, you need like a translator with you to figure out what they're saying. It's wild. It's like you're like in a different time period. Oh, I can't hear you. Your mic's off. You're muted.
Hey,
there you go.
Hear me now?
Yeah, hear you.
Sorry about that. You might have to edit it.
All right.
But it's It's great to take one of those trips also where you kind of just set away 3 weeks. And I had a few meetings I had to take while I was there and some company visits. But pretty much most of the days we just woke up in the morning and said, let's go drive 100 miles in, whatever direction you want on the map. And we'll stop at everything along the way. And that's kind of what we did. And yeah, we never
That's
made it to
awesome.
West Virginia. Eventually I had to get home. I have a
Yeah.
job.
You actually have work to do.
Yeah, I mean, if not for my job, I mean, we probably would just cleared all the way to the West Coast. But I have stuff to do.
What do you spend most of the time doing at your fund?
Reading. I cover. So what I do, I mean, and I don't know how many of your viewers know about me, but I do two core things. We do small cap growth. Unfortunately, right now, anything with any sort of revenue growth of any type trades at earnings multiples that are just insane. So I'm not really doing much of that. Every once in a while, one of these little companies will slip through the cracks, but I'm just not doing that much of that because there's just nothing to do. And then I'm doing a lot of inflection investing. And, you've heard of global macro, but that's really like interest rates and currencies. I'm looking at these smaller sectors that people aren't really following very closely. And I'm waiting for inflections, whether it's, commodity focused or it's some sort of, asymmetric thing, or it's even just an individual company that's going through some sort of dynamic change. But I'm following lots and lots of sectors, probably 200 weird esoteric sectors that no one really thinks about at all. And then I'm, in following them means reading, industry publications and watching, presentations, because I guess there's no conferences anymore. But just staying up to date with what's happening in these weird, quirky sectors that have been forgotten by finance. And when I'm not doing, and then, that leads to a couple hundred companies I'm following. And those companies, you're just following the news and trying to say, this thing is down 90% in the last 10 years. When is it going to get better? Or when's
Yeah.
something going to change? I mean, I always say that the most money in finance is made when something goes from hopelessly fucked to marginally shitty.
Yeah.
And, something that's down 90%, if it goes, to down 60%, it's a triple. And, that's a pretty good year. So,
Right.
I mean, we're watching these things. We're trying to get the inflections in them. And, I work with another guy and, I have dozens and dozens of real smart friends. So they're always calling me up, hey, Kuppy, have you looked at this? And what do you think of that? And I'm doing the same. And we're just trying to cover a galaxy of information. And, so at the end of the day, I spend most of my time kind of sitting right here at our office and just reading. And, whether it's like thousands of emails or stuff that people send me or, just stuff on the internet, I'm reading something at all times.
Yeah.
That's what I do all day.
What would be some examples of some of these very cryptic, esoteric industries you're looking at?
Well, I'm really big in home building right now.
Okay.
It's a sector that's kind of peaked out in 2006. So it's 15 years of pretty much nothing. It bottomed out in like 2010 or 11, and then it just kind of bounced along the bottom. And it's been a 15-year period with a lot of consolidation, really weak demand, and demand's gone parabolic right now. And home building itself is a pretty awful industry. It's just capital intensive, low returns on capital. It's you don't want to be in that.
Yeah.
But the guys who are supplying the home builders, the parts for the homes, windows and doors and pipe fittings and siding and stone facade and all these weird things that you never really think of when you look at a home, all the components. There's been huge consolidation in the industry, and you really have a one and a two in these little verticals, each of them, and there's really no three. And because of that, you have huge pricing power, and the Toll Brothers of the world, they'll basically split their orders between the two players because, they'll try to play them off each other a little, but these are actually really good businesses. And I mean, I didn't realize how good of a business they were until you look at them and you say, wow, these things were earning 20% returns on tangible capital at the bottom of the cycle, and now we're inflecting up. Maybe they'll earn better, and they put a couple turns of leverage on them, and they're earning 100% a year. Like, but it's one of these weird things. Like, you'd never think that stone facade is a great business.
Right.
Exterior cladding. Like, like I never think about these sectors,
Yeah.
but you start learning about them, and vinyl windows, and you start learning about these sectors, and what's changed and how technology has made it so that it's all about scale, and it's all about just-in-time inventory for the home builders. So you need to have facilities near where they're building. It's interesting, and it's a sector I've been following kind of loosely because it's been down a lot for a decade. We've been following this for a long time, and we never really pulled the trigger really until this summer. And I mean, a lot of the stocks doubled and tripled already. It's pretty good, honestly. But I think there's a lot more runway. But that's one of those like quirky, weird sectors. I mean, what we're looking at right now, I think nat gas is about to have another turn. That'll probably.
Why is that?
Just because they're drilling less. We're going to go. We've gone from like 95 BCF a day in the U.S. This time last year. Basically, we're in the mid 80s right now. It bounced around week to week, and there's hurricanes and stuff. But let's say we've dropped already 10 BCF. Part of that is just that there's been a lot less drilling. But part of that also is the byproduct gas that comes from oil shale. The oil guys, like, if they have $1, they'll put it in the ground because their mission in life is to light money on fire. Like,
Yeah.
I don't know why, but they just get excited to destroy capital.
Well, it's like mining.
Yeah, but mining, it's just like mining. It's a little different.
They do similar shit. I mean, most of these mining companies are just have pretty horrible returns over time. And
But the mining, and there's mining, which is actually operating the mine, and then there's the other part, which is gamblers that put holes in the ground hoping to find gold.
Sure.
Because you can make you get to make 100 times your money, so people will always fund to dream. If some guy says something and the geology sounds promising, someone will fund his dream. But with shale, exactly what your economics are going to be to within 5-10%, and you're lighting money on fire, but you're just going to do it times 100 wells a year. And I just don't understand it. You could build a spreadsheet that shows capital destruction.
right.
So anyway, that's been happening for a decade, and finally the money got pulled away from these guys. So they're drilling less. There's a lot less byproduct nat gas. Remember, these guys are drilling oil wells. They want the liquids, and the gas side they don't really care about as much. So they're not really focused on the gas price, and it's just kind of some extra revenue. And so when they stopped drilling for so much for oil, the gas was just trailing off too. And in the end, the U.S. economy, COVID, it kind of hit demand a little, but it didn't come off as much as oil came off, and it's recovering very fast too. So gas demand is good, supply is down, capital's down. There's a bunch of LNG uptake expected in the next couple of months. It looks good, I think. And
Are you looking at equities or
always equities?
Yeah, okay.
I mean, I'm not going to trade the futures.
Or the bonds? Do you look at the bonds at all?
We've looked at some of the bonds.
Yeah.
But in the end, I'm an equities guy.
Yeah.
You have the most torque there. And a lot of these things, I mean, are bombed to bits. You can look at the charts and they're all down 95%. And I mean, 5 months ago, everyone thought they were going bankrupt effectively, and the bonds are trading in the 20s and 30s. Now the bonds are 50s to 70s in the stuff I'm looking at. And the equities kind of had a big bounce and they pulled all the way back. And, we own quite a few of these. Are
you comfortable talking about a few of these names?
I mean, the one I'm, I guess, most excited about is the one that's the shittiest.
Yeah.
It's Sandridge.
Okay.
I own a lot of it. It has no net debt, which is, what allows you to own a lot because you have no risk really. They're not drilling anymore. New CEO came in and said, to hell with this, we're lighting money on fire.
Now, Sandridge did go bankrupt before, right? And they
Yes,
came out of bankruptcy?
yes.
Okay.
Yes. But the new CEO, I think, is actually really sharp. I like him. I've talked to him a few times, and he's just cut a ton of costs, cut a ton of people. I think in the end, if you're looking at $3 nat gas and you're looking at $40 oil, this is going to earn something basically around the market cap each year. And of course, it's trailing off like 20% a year. But you're going to basically get your market cap back in cash this year. If you think nat gas is mid-high threes, you might make more than the market cap. You kind of build a model for what you expect the future production to be that's effectively PDP, and you have a price that's way higher than today's price. And unlike a lot of these companies where if you're off by a little bit because of the financial leverage, you could be insolvent. Here, if you're off by a little bit on the PDP, you're just off a little bit. Maybe it's only worth $5 instead of $20. It's kind of whatever. I don't think it's worth $1.50 or $1.75 wherever it's trading. And I've been wrong on it. I've owned it from higher prices, but when it got down to $1 and went below $1, I bought a whole lot more. And it's a reasonably it's my largest gas exposure.
What percentage of your portfolio is that?
I'd rather not say,
Okay.
but it's a top 10 position, put it that way.
Okay.
It's the biggest piece of my gas exposure.
Do you stay pretty concentrated generally, or how do you look at that?
We run a very concentrated book. We're 6 to 12 positions at a time, and a position might be one company, or it's going to be a basket, like what I'm doing right now at Nat Gas. So I have a Nat Gas basket. It has a couple names in it, and then I also have some thermal coal because it's the most hated sector. And you can't have anything this hated without eventually having a recovery in share prices. So I have a couple of thermal coal plays tossed in with my Nat Gas because they're all kind of based on the same pricing deck. And if Nat Gas is the strip's already above 3, but if basically Wall Street's saying the strip is not going to stay above 3 because otherwise the equities would be trading better. And I'm saying I think it probably stays there for a bit. But if the strip stays 3, my thermal coal names will do a bunch of cash flow, and they're just as torqued to the upside. So anyway, it's one big basket of thermal and natty.
Love it. Now you're doing a lot of event driven situations too, right?
Yeah, we've done a lot more of that than I've ever done in the past. I don't know what happened in March, but ever since March, there's just been a lot more opportunity. I feel like there used to be a lot of event-driven funds that must have blown up, and they're just not contributing capital to close spreads, or they're not playing pretty obvious stuff that used to get arbed out faster. There's also more volatility in the market. The markets have just gotten more volatile. We went from a 12 vol to a 30 vol. So there's just inherently going to be more opportunity because of that. But I don't have to really worry the why. I just know that these strategies that kind of go in cycles. You'll have a few good years, you'll have a bad year. You'll have some strategies do very well, like option writing will do very well one year, and another year, syndicate will do well. But you kind of move around in these strategies. They're pretty much all doing well, and they're doing really well right now. And so I've been spending a lot more time on them. And some of them are just basic stuff, like you have a SPAC and the warrant will trade very wide of intrinsic, and you can buy the warrants and sell the common, or you can buy the warrant and sell calls against it, or buy puts. How you hedge it that's up to you. How do you hedge it? But if you find something where there's a $10-15 spread and a $30 product, there's enough arbitrage room there that you don't have to be all that smart to harvest it. But that's literally like prosaic, easy stuff. Your risk there is that your borrow gets called away or the spread blows out wider. So you're never going to play any of those too big. But there's other stuff. Like I wrote about this Dillard's. There's a situation.
Yeah, tell us about that.
Yeah, sure. It's a quirky, weird thing. I do a run every week of highest short interest. It's just I like looking at those things. They tend to mostly be frauds, so you're not going to actually play any of them. But every once in a while, something pops up, and this Dillard's is this quirky, weird thing. Dillard's itself as a business is it's a department store chain. It's probably dying, but it's like 2 times last year's cash flow, and it's not dying that fast. And they've been using their cash flow to buy back stock. I don't know if it's the right decision for corporate or not, but that's what they're doing. And there's been this short interest that's been pretty constant for a very long time. And as they buy back the stock, the float keeps getting squeezed. You have this weird situation now where there's 6 million shares short. There's about 5.5 million in the float once you take away the pension trust and you take away the management insiders. So there's already more shares short than there are in the float. And then when you realize that the ETFs, depending on how you add it all up, there are another 1.5 million to 2 million shares. You could have as little as 3.5 million shares in the float versus 6 million short, which really should never happen because I don't know how the shorts will ever cover. It sets up for one of these like infinity squeezes if they choose to cover. What got me really interested is this has been kind of going on for a while. So you'd have always people say, yeah, Dillard's has high short interest and it'll squeeze. And Dillard's would have these $10, $20 squeezes and then it kind of come back.
Yeah.
What got me really interested this time is that the borrow cost started spiking, which indicated that something was, happening there in stock lending. And so I bought a bunch of shares and I wrote about it, and the stock popped a bit and the stock pulled back, and I bought a bunch more. And I lend my shares out. I don't really care. I'm happy to earn the borrow fee. I'm not trying to manipulate it. But, I came into this, my average about $28, $29, and it got all the way to 42, and that's a pretty good return, I think, for a month or 3 weeks.
Yeah, not too shabby.
Not too shabby. I mean, remember, I'm not playing any of these too big. I mean, the thing about event-driven that I think people make a mistake with is they play one trade too big, and that one doesn't work. And, they go, oh, event-driven doesn't work. I'm down this year on it. The whole point is you want to roughly be equal-sized. And you're playing the law of averages, and you're just playing the numbers that, every one of these situations I have edge. I don't know if Dillard's is going to go up this month or next month, or, even when I put it on, it could have just sat there at 28. But I knew that if you have a balanced book of a dozen of these sort of situations, some of them are going to work, some of them are going to go nowhere, some won't work, but the odds are very much in my favor. And, if Dillard's goes, what did I make? I sold mine yesterday at 41. So I made $13 on 28. That's, 45% or something. You make 45% on something, it balances out a lot that don't go anywhere or even go down a little. And, but anyway, there's a lot of these strategies, like short squeeze has done very well this year, actually surprisingly well. All of them done well. And I've just been following a lot of these sort of strategies, and I don't know, it's the sort of thing that usually, makes a bit of money. And oftentimes event-driven is not so much that you're going to make money on that one discrete event, but it sets you up for something better. So one of the things we track very closely is CEO change, for instance, especially companies that are down a lot. Eventually the board says, we're done, and they fire the CEO. And so, the press release will say something like, effective immediately, the CEO has been fired. Someone else is stepping in as an interim, and we're going to search for a permanent CEO. And usually the stock drops. And the stock drops because the board's looked at the Q3 numbers preliminary, and it's a bloodbath,
Yeah.
So, but in reality, the stock should probably be going up because, this guy has ran the company into the ground, and he really should have been fired 2-3 years ago. And now you're having the change come. And if the assets are good and, if the bones of the company are still viable, a new person probably can fix it. And you have this sort of situation where they fire the guy, the stock usually trades down. Eventually they hire the new guy. He takes a big bath. Think of Bed Bath, for instance, they eventually fired the guy. The new guy took a giant big bath charge. The stock kind of traded down. It dropped in half almost from the day they hired him. And then, bounced around for about 6 months. And the new guy, started to make some progress in turning it around. And, he was dealt a bad hand with COVID, but it's starting to show progress. And here we are at 20. But the stock, after he big bathed it, was like $8 or $7. And 6 months later, you're at 20. And that's kind of the cycle I'm talking about. So you'll watch it event-driven and be like, oh, they just sacked the CEO. The big bath's coming. You could short it and make 20%. And, 70, 80% of these will work, okay?
Yeah.
It's just a numbers game. But it also sets you up to say, who's this new CEO? What's his plan? Let's call him up and see, how he's thinking about this. And let's watch the data points along the way, because if it turns around, it turns around. And so, event-driven can lead to a full-on investment position. You shouldn't just think of it as, I'm going to grab this 20%, edge or whatever it is, and I'm done with it. It's a lot of them, it leads to something more. So anyway, I really like the strategy, because whenever you have some sort of dynamic change, you're going to have share price movement. And usually with dynamic change, you have dynamic share price movement. And in the end, I'm out there looking to earn very, high returns on my capital. So I want stuff that's moving.
Do you ever look at, say, when there's a CEO change and go even further than that and screen for, say, CEOs that might be coming in, maybe with a CFO background or an M&A background, with the speculation that, there could be some kind of deal in the works, which is why they're bringing a new guy?
Yeah, you can look at it in
so I've looked at that before.
ways.
It's kind of interesting, and that's worked out.
Going back to Sandridge, okay?
Yeah, sure.
Carl Icahn, who controls it, he had this plan to drill out Colorado, which at $80 oil would have made a ton of sense, and at $40 oil, it's suicide. So he had a guy who was drilling, and they lit a lot of money on fire because they guessed wrong on the oil price.
Yep.
Carl now is down a lot of money on this investment. They brought in a new guy. This guy's a cost cutter. He's not a driller. He's actually an iBanker. His last company, he was hired by the bankruptcy, is Jones Energy, which is also another lemon of an asset. But they put him in as CEO while it was still in bankruptcy. He took it out of bankruptcy. He cleaned it up and he sold it.
Yeah.
That's the guy's background. If you look at his comp package, he's very well incentivized at Sandridge to clean it up, get 3 good quarters, and sell it. Like, that's the way his comp package is structured. So all you have to do is read the guy's comp package. Will he do something different with it? I don't know. Maybe. I mean, if there's value to be created, he's going to create value, I think. Yeah. But I mean, his incentive is to sell it for, 75 cents on the dollar of PDP, which, probably gets me like a $10 to $15 share price. So, you just have to look at all these things. And yeah, you're right. Every CEO is different. But if you look at their background, you can figure out what they're trying to do and, what they're likely to do.
Yeah, right. Now I want to, you wrote a thing, this maybe a few days ago on Joe.
Oh yeah.
We should talk about that. Cause that's
yeah, sure.
Very interesting. And that's been one of these value names that, God, I don't know. I feel like it's been around since like I'm a kid. It's gone nowhere, for like 10 years, 15 years, something like that. So tell us the deal with the business and give people a background for those that are not familiar.
So St. Joe, ticker symbol is JOE. They own 175,000 acres in the Florida Panhandle. Used to be a timber company. They have exited the timber business, though they do sell some logs. And now they're developing the property they have. It's been dead money for 15 years, as you said. I don't think anyone ever doubted the value of the land. There's been some short sellers who've gone out there and said, oh, this is worthless swampland. But I mean, it's not swampland. It's some of the most beautiful land in the state of Florida, and it's actually the highest land in the state of Florida. Walton County is the highest point in the state of Florida. I
just want to say before you go on, I think a lot of these, just in general, these publicly traded businesses that just have a ton of land on the books, a lot of them have gone nowhere for a long time.
Yeah. They've gone nowhere. I mean, the stock market's funny in that you can look at something and be like, I think the NAV is north of 100. It might even be 200. But, it's not going anywhere right now, and it's dead money, and there's no catalyst. So we're just going to ignore it, and we're going to let it trade at 20 cents on the dollar forever. And I mean, a lot of very intelligent people looked at this and came to that conclusion, which is fine, whatever. Yeah. They're probably right to make that conclusion, quite honestly, because it's gone nowhere. Which changed.
And if you're never going to get that money collected, then maybe it should trade at that price, is what they would say.
Right. I mean, if you're going to go in there and you're going to sell off the acres to someone else, then yeah, you're going to create a lot of value. But if you're not going to sell off the acres, then it's just kind of trapped inside the entity. Which changed is that the Panhandle has hit critical mass now, and it's actually growing very rapidly in terms of the population. You have this weird chicken and egg problem in any area that's sparsely populated. People want to go there, but they're not going to go there if you don't have stuff for them, like schools and hospitals and grocery stores. And, you can't build those sort of amenities unless you have people. Right. So you had this very long-running chicken and egg problem. I mean, Joe actually had to donate land to build an international airport there because you couldn't even get there. He just think of the building blocks of a community. Yeah.
But it's a real issue in a lot of parts of the country.
Yeah, and you need someone who owns enough.
Oh, your mic cut out again. Can't hear you.
Can you hear me now?
Yeah.
Sorry about that. I don't know why it's doing that.
I don't know. All right.
You need someone who owns enough acres and is committed enough to make those acres valuable to make it work. And
right.
Joe's put in the hard time, and now Walton County and Bay County are 2 of the fastest growing counties in the United States, admittedly from small bases. but they're growing really fast, and you have demographics on your side here. Migration into Florida is going parabolic, really, as people go to Florida with zero state tax. But you have people leaving the cities. You have people wanting second homes by the water. The land where Joe owns it's called 30A. It's a strip of land along the ocean there. It reminds me a lot of the Hamptons, quite honestly. It reminds me a lot of me being a little kid and going out there, and it was just potato farms. There's nothing there. You had some nice homes on the water, but you go basically, what is it, 200-300 feet inland, and there's nothing. And now they built $20 million homes inland. So I think Joe's going to do the same thing. They have been doing the same thing. And if you look at every metric from lot sales to club membership to hospitality, to every metric you want to look at is going parabolic there. They're all growing 30 to 50% a year. And we're in a world that's addicted to growth stocks, and here you have a company that's growing 30 to 50% a year. And no longer is it just, hey, there's a bunch of land doing nothing. It's really growing fast. And I think 2021 is the year where funds from operations finally show up. Property development's a funny thing in that GAAP accounting kind of bastardizes it. And so what you end up happening is you have fixed overheads, you have assets at the asset level that are producing cash flow, but the fixed overheads are hiding them. And every time you build another asset, you have to hire more employees at corporate in order to build the asset. So as you grow, you really don't show a lot of cash flow. You look at the cash flow statement; it's kind of a muddle also, because you might show a little cash flow here because you're sure about the depreciation, but then you also have a ton of capex, and it's hard to pull apart what's maintenance, what's growth, what's and then you have you have lot sales, you have hotel development, you have multifam. There's so many moving pieces. It's just kind of a jumbled muddle.
Yeah.
But when these people start looking at this revenue growth that's going to be 30, 50% a year, I think they're going to be able to pull it all apart. Well, they might not pull it all apart in terms of funds from operations, but they're going to be able to look at this and say, this is growing fast. And, it's not like it's tiny. I think they'll do almost 200 million of revenue next year. It's not a small company anymore. So if that's growing 30 to 50% a year, at some point you hit the critical scale, and the market's going to appreciate that Florida is one of the fastest growing states, and this is the way to play Florida effectively from a macro standpoint. And you can go asset by asset and figure it all out, or you can just big picture it. And I tend to think they'll do almost $2 a share of funds from operations next year, and there's a bunch of one.
And what's the stock price at right now?
It's a $25 stock right now. It was 21 when I wrote about it. And one of the things I found with this blog, I have a blog called Adventures in Capitalism, and I recommend people sign up. I'm not
I do too, by the way.
You do what?
I say I recommend people sign up too.
I appreciate that. Thanks. Yeah. I write about once a week, just kind of whenever I get around to it. It's a free blog, so you get what you pay for. But I found that when I write about something, if the thesis is good, people reach out to me, and the stock sometimes moves a little. If the thesis is, if I'm dead on it, it's like, the stock might go up a little, and if I'm wrong, you can say as much as you want, just the stock will go nowhere. It's I've learned, having done this for 10 years with the blog. And so I put some eyeballs on St. Joe, and I'm surprised actually, because the stock spiked from 21 to 25 in 3 days. So clearly, the story resonates with people. And clearly,
it was the Kuppy effect.
It's not a Kuppy effect. How many times I've told people I think sandwich is cheap? I mean,
I'm kind of fucking with you. It's funny. Like, I've talked about some pretty thinly traded securities on this blog, or on this podcast. there was one actually where I was like, well, I don't know if I want to talk about this, because then it's going to prevent me from buying more. I talk about it on the show, have a guest on. The next day, the stock is down 20%. So who the hell knows?
Who the hell knows? But look, Sandwich is 50 million market cap. My friends and I own a good chunk of it at this point. It never goes up. So, the market's telling me that I'm either early or I'm wrong. And, early is a form of being wrong, I guess.
Maybe.
And yeah, but I'm not making money with it.
Right. Yeah.
So, when you see people
But
look
to
at
be
Joe.
fair, though, I mean, you see some of these businesses where there can be dead money for a few years, and all of a sudden in a week, something happens, and you make all your money in a week or two.
Yeah, that's usually how it works, actually, especially in small cap.
Yeah.
Small cap's funny in that, when you look at large cap, there's enough people following it that it'll just kind of grind higher if the thesis is working out. You
Yeah.
might have spikes around earnings, but it'll just grind its way to wherever it's meant to go. Small cap will just sit there, and then one day you wake up and it's up 50%. And 2 days later, there's a press release, and you're like, "Oh, that's what's
That's what
happening."
happened. Yeah.
Yeah,
You'll never see that with Coca-Cola.
No, I mean, actually, in 2018, I put on 11 total positions. So I run a really concentrated fund.
Yeah.
I put on 11 total positions over the course of the year, and I had 5 of them either get acquired or someone go activist or hostile, where someone someone made unsolicited tender for the company. But I had 5 of 11 where it was cheap. It was cheap. I went home every day. It's cheap. Keeps getting cheaper. And one day I'm up 75%. It's just,
Yeah.
you wake up in the morning, it's like, this has been a good day.
Yeah. Yeah. Exactly. So what do you see as the future of Joe if you look, let's say, 5 years out?
I think it's just going to keep grinding higher. I don't think it's going to be any fireworks. It's a steady Eddie. I really like the management team, by the way. They're
What is their background? I'm not actually that familiar.
just property development. But I mean, the new management team came in about 5 years ago. They had a guy in place earlier who was from Disney, and he just spent a fortune, and he tried to build all these grandiose things, and they didn't sell well. He didn't understand the market very well, and he just spent too much money. And the new guys came in and they said, let's go hit some singles. And they've been hitting singles, and they just keep tying it all together. And they're doing really well. And I think, you're going to continue to see almost every month another announcement of another project. Every project, I mean, what Joe's doing that's, I think, different from a lot of property developers is they're saying, we're going to partner with people. We have the land. We're going to contribute our land into a joint venture. Someone else will do the development, which is the risky stuff. You go over budget, bad things happen. Joe's just putting their money in. They own a percentage of whatever happens. But also, if you look at like Howard Hughes, which is another land play, it's been kind of a disaster. And the reason it's a disaster is they're building it all themselves. So they have their cash going out the door. So when
your mic cut off again. Nope, still not working.
Am I back now?
Yeah, you're back now. So last I heard is when COVID hit was the last thing you said. That's okay.
Oh, I don't know why my microphone's having trouble. Sorry about that.
You're good. All good.
I've never said technology was my thing.
Yeah.
No, but when COVID
luckily
happened,
you're not in IT, so.
Oh God! If anyone knows a good IT guy in South Beach, Florida, I'm ready to hire you.
Okay.
When COVID happened, they had cash coming out the door because a half-built building is worthless.
This is Howard Hughes.
Yes. Okay. They had basically these buildings they had to complete with no money coming in, and they did a down round and diluted.
Oh, your mic cut off again.
Why is it doing that?
I don't know. It's weird. We'll try that one more time.
Let me take this from the top. Can you edit this?
Yeah, I can edit it.
Sorry, I don't.
It really won't need that much editing, but it's okay.
All right. So, the problem with Howard Hughes is that when COVID hit, they had cash going out the door to finish their property developments, and they have no cash coming in because all their revenue stopped. So they did this down round, diluted everyone. The other problem with Howard Hughes is that when you want to build a big building, you end up with a lot of very expensive employees sitting at headquarters. You have, architects and designers and permitting guys and quality control guys. But all these people are costing you money. So you have this bloated overhead, which means that, as you're growing the business, you have this overhead that's growing sometimes even faster than your revenue because there's a lag on the revenue side. You have to build it and lease it up and stabilize it. And it's this giant drag. And then the other problem is that if you have these people on payroll, you're kind of forced to continue building stuff, even if the economics of each project don't work.
It creates a bad incentive.
Well, you have this sunk cost. So, what Joe is doing, they have a lot of, expensive people on payroll, but they're trying to focus on joint ventures where, they're going to partner with someone else and let someone else take on all the headaches and let Joe do the stuff that Joe knows how to do, which is basically manage the assets when they're stabilized, because they have the presence in the Panhandle that a lot of property developers don't have. So I think it's a very good partnership for anyone who partners with them. But I also, yeah, and I think it's a better business model. It's a higher return on capital model.
Yeah.
But what I expect that Joe will do is they'll keep announcing new projects. And, I don't expect any one of these projects to really knock your socks off. It's going to be, we're going to build a gas station over here, and, we're going to build a strip mall over there. We're going to build a, 100-unit hotel over here. None of them is ever going to move the needle. I've spoken with a lot of guys who've looked at Joe and they try to get really granular. We think, this hotel is going to be at this cap rate, and you can't do that.
I think it's a waste of.
It's a waste of time.
Yeah.
I mean, this is kind of like hand grenade stuff. If you're sort of close, you're going to make a lot of money. And, do you think the thing is worth, today's quote, or do you think the assets are worth many times today's quote?
I think if a thesis would be dependent on a hotel that doesn't move the needle being developed at a 7 or an 8 cap, it's probably not a good idea.
Right. And yeah.
Plus, you only have so much time in the day. I mean, to be spending, and this has always been my thing. If you're spending 1,000 hours on this very detailed analysis when you could spend 5 hours on something that's going to be fairly accurate, it's like time is a resource too, and you're going to be wrong on half the shit anyway.
Yeah.
It would be like, analyzing Clorox and then going to every supermarket in the country and trying to figure out how much is going to be on the shelf and what shelf it's going to be on. It would be a waste of time.
Yeah. I mean, I very much think that you make sure when you enter a position, I'm a value investor at heart, that you're coming into it at, 20 cents on the dollar. Like, I'm not the sort of guy that buys something at, $20. I think it's going to 23. That's not who I am.
Yeah. Buffett has actually talked about this. It's very interesting how many people talk about how much they love Warren Buffett, but then that they go off the rails on their own thing. Or, Buffett talks about, he's like, if you need to have that level of precision, it's probably not a good idea. But, I think the investment community attracts a lot of people with more of an engineer's type headset, and they want to drill down and have these like fancy spreadsheets on every little aspect of a business. And it's like, okay, buddy, but it's kind of a waste of time, but do what you want to do.
So my epiphany on Joe was I went there in 2018.
Do you know what I mean? Do you know what I'm saying?
Yeah, absolutely.
Yeah, okay. Yeah. Okay.
Yeah, I mean, it has to be obvious. I went there in 2018. A friend dragged me up there and said, this is the first annual meeting they've had where they've televised it, which is kind of like, the company had been quiet for a very long time. And, it's management finally saying, hey, look, we've made some progress. We're kind of proud of ourselves. We're going to televise the annual meeting. And I called up the CFO, and he said, if you come up here, I'll give you a map of what we own. And they'd never released a map of the assets before. So I said, okay, that's interesting. Something's changed at this company now.
Yeah.
And I like seeing change. And that's the sort of change you want to see, where management's proud of what they've accomplished, and they're going to tell the story.
Yeah.
Usually after that leads to like, non-deal road shows, and, they had the analyst day, and, Joe hasn't done that yet, but they've kind of opened up and showed you what they're doing. So I went up there with a friend. We drove, it was like 12 hours or something. We went to the annual meeting. They gave us the map, and we start driving around, and we're, I'd never been to the Panhandle before. We go to 30A because we're just looking at we're just following the map, and they gave us kind of a route to take. And, we stop because we see these ginormous homes that are like, you look on like realtor.com on your iPhone, and they're like, 20 million each or something. And I'm like, wow, that's a lot of money, because I didn't expect that in the Panhandle. Yeah. And then I'm saying to myself, that's weird. It's just, you have the like 2-3 rows of these, and then there's just like trees as far as the eye could see. And I look at my map and like, oh, Joe owns all that. And then we drive like a couple more miles, like really nice homes. And then there's like, a mile of, trees, and there's more nice homes. And pretty fast you get to realize that anything that's not developed yet is because Joe owns the land. And then you start looking at, you do a back of the envelope of, you put 2 homes per acre, and these are $20 million homes, and your build cost in these homes is negligible. It's like $200 a foot or whatever. And you're kind of like, so the acres are like $20 million acres, and Joe's has like thousands and thousands of them. I mean, you kind of, you just kind of backwards engineer into what the things are worth, and you're like, wow, like there's zero chance this thing is worth what it's trading for. It's not even.
Where did the swampland thesis come from?
I don't
It
really know.
doesn't sound like swampland at all.
I've had a number of people write to me that it's swampland, but there's actually very
Who was the
little.
famous short seller that was shorting this?
Einhorn.
Was it really? Was it Einhorn? So I think
Yeah,
Einhorn was the guy that used to call this swampland.
The odd thing, actually, and this is, I think, one of the funniest. So they do have some swampland. They've turned it into a conservation park, and they were able to get a lot of environmental mitigation credits that they were able to use to increase the density of some of their other development assets. And as it turned out, the swampland was the most valuable thing they had. Because, I mean, it's the reason they were able to, like, if you look at, they have it's called the Bay Walton Sector Plan, which is approved by the government. And it's kind of like a 50-year plan of how to develop their land. And they were able to get pretty dramatic densification, especially in a commercial space, because they put about 50,000 acres into permanent conservation because they were swamp. So, right. I mean, the swamp actually created the most value.
So funny.
So yes, there is some swamp. It is a conservation easement now, and it'll forever be swamp. And it's created the most valuable possible.
Yeah. So it's interesting. Yeah, I think you got to be, even if you weren't bullish on Joe, because there's a lot of these other land plays that, are not as interesting. But I think to short a land play is a little crazy.
So I don't know who's short this anymore. Einhorn was right in 2007 or so. It just wasn't growing very fast. What Joe did was they sold off their oceanfront, and they had a couple of years of pretty large revenue and earnings. And then after that, there was nothing to come. They didn't really have any, plan to build commercial space or, build annuity revenue. They just kind of sold pieces off, and it made no sense what they were doing. And Einhorn is right, and the stock dropped from 80 to like 15. But I don't know who's still short. There's 6 million shares short, and there's like 10 million shares in the float, maybe.
Yeah, it's a little odd.
It's very odd, actually, because I mean, so I went there. I was there 3 weeks ago, and I had some friends come join me, and we rented a $2 million place, and we rented it for 2 weeks. And it was beautiful, but a bunch of guys running hedge funds, they came join me, and we drove around. And I'd driven the assets before, but when I always get a kick out of seeing other people's impressions of assets, because I'm known to have my own views, and everyone's just like, wow, I can't believe it's a $20 stock. Like, they just couldn't get their head around it, because it's so obvious that 100 a share is the lower floor, and depending on how you build your model, you could be in a couple hundred a share. And so I don't know who's short this thing, but they obviously have done shitty work.
Yeah. On that note, interesting. Anything else? I want to wrap it up in a few. Is there anything else that's like pressing or really, really interesting that you think is worth talking about that we just haven't covered? We've gone through a lot. It's been almost an hour.
Yeah, I think the thing that keeps going on my mind right now is degrossing. You only make money in this game if you have money at risk, and it's very hard for me to look at a portfolio of positions and say I gotta throw one into the volcano. But I've just told I usually run a book that's like 120 gross. Okay. That's kind of like my target. And I've been running 140 just because it's Project Zimbabwe, which means that the Fed has your back and stocks will never go down. So I've just been running more gross. And I need to pull that back. Like, I want to buy October expiration, which is in 7 days. I want to be under 90. So I'm just selling, and I'm just pulling positions off, and spreads that I had on haven't closed, gone. I have options that expire in October. I'm not reloading them for November. I write a lot of puts just because it's a good way to get long cheap stocks, because you just write a put at a discount to the market, and either you get your couple percent premium, or you get long something you want to get long anyway at a great price. I'm not reloading those, but it's just harvesting the book. It's hard, and I don't know what's going to happen at the election. It's very likely that it's a clean election, someone wins, life goes on, we all kind of forget about it. Or it's very likely that it's a hung election and markets hate chaos. And I mean, you can look at a lot of scenarios that are pretty awful.
Yeah.
And so you don't have to have money at risk every day of your life. I don't feel like I'm risking a lot. I mean, if the election goes off without a hitch, was the market go up 5% that day? I could just reload, or just sit there in cash and wait for the next set of opportunities. Every day of your life is a new opportunity, or something really awful could happen, and at least I'm going to sidestep it a bit and have liquidity to buy whatever sectors get blasted. I don't think people think enough about just systematic degrossing, because in the end, you especially in the hedge fund world, we're paid to take risk and earn
Yeah.
returns, and you're not really paid to degross. And I don't know. The most likely scenario is nothing bad happens, and I was dumb to degross.
Yeah.
But I don't feel like I miss much if I don't. And so anyway, I look at my book every day and I say, like, what am I going to sell today? Because I got 7 days left and I got to find 1,000 bips. And I have my core positions. I'm not selling any Joe. Like, if Joe went to 50 tomorrow, I wouldn't sell it.
Yeah.
But I'm not selling my Sandridge. I'm not selling my tankers. Like, what am I going to sell? And that's hard. So
Yeah.
I don't know. That's what I'm thinking about every
I
day.
feel like selling is always harder than buying.
So when it goes up, it's easy to take profits. When you're down on it, it's always easy because you can say I got it wrong, or you get a tax loss, and I've had a really good year, so I need some tax losses. But it's really hard when you still believe in the position and
Yeah.
things are sort of going right, but the market hasn't yet paid you for it. Your catalyst is imminent, or maybe it's already happened, but the stock, it's up 10%, but you think it's got more legs. Like, those sort of things are the hardest.
Yeah. No, for sure.
And then I guess the other thing people forget about degrossing is that you can degross by selling, or you can degross by selling calls. And I don't think people do that enough either. If you own a stock that, you paid 5 for it and it's gotten to 10, and, you don't want to pay tax and you don't want to take it off, so you really think it's worth 20. If you sold the 12 calls out 2 months, you get paid $1. Well, you've just taken, it's the equivalent of selling 10% of your position in a way.
Yeah.
And there's a lot of ways to structure degrossing. So, you got a lot of, puzzle pieces, use the puzzle pieces,
Yeah, totally. Cool. All right. Well, if people want to either get in touch with you or, learn more about what you're up to, where should they go?
Adventures in Capitalism, sign up there. Like I said, I have a blog and I write whenever I feel passionate about some topic, or I see something interesting that I like to share. The origination of my blog was I used to have an email chain to about 50 friends, and it just got unwieldy and I forgot to copy people. So I built a blog, and from about 50 people, it's grown to where it is today. I've never marketed it. It's just people come find it and sign up for it. In terms of my hedge fund, it's called Praetorian Capital, pracap.com, but you have to be accredited. And otherwise, just email me. I'm easy to get in touch with.
Okay, great. Well, Kuppy, it was great to have you on the show, and you're welcome to come back on anytime.
Hey, thanks. Appreciate it.
Yeah, of course. All right, take care.
You too.
All right, bye. All right, stay on. I'm just going to stop the recording.